Good morning, everybody. It is April 23rd, 2021, and we having ourselves a stock market and more politics and more stuff and things. So let's crack these narratives wide open. Is the capital gains rate hike the end of the bull market? I don't think so. I think the bull market was already ending halfway. Tax increase is going to impact less than 0.5% of the population, only those making over $1 million per year. How consequential is that going to be? Smart money in the stock market was already selling into the market strength, so it really doesn't have a lot of impact. Could be seen as an excuse by some to sell, whatever. The technical traders will tell you this is a reason to sell. Who cares what the technical traders tell you about reasons? They just make it up as it comes. Hey, look, I want it to run this way, so I'm going to tell a story. I want it to run that way, I'm going to tell a story. Why? Because it makes their trades good. Who cares? Let them tell their stories. Ignore them. They're technical traders. They don't care about fundamentals. They don't care about economics. They don't care anything other than about a chart and dislocations in the market that they can cause or take part in. Ignore their narratives because technical traders only care about the charts. And some of them are cheaters. They'll try to change the charts. Not many, but there's big enough money out there that on penny stocks and on SPACs and in certain narrow sectors of the economy, they can cause a dislocation. And I'm going to show you one here in a little while. So, the big deal with the market here is in capital gains. It is and has been QE for a long time. So let's not forget that. But let's talk about capital gains. What are some of the stupid arguments that you're going to hear about why the capital gains rate should be low? The tax is not adjusted for inflation. Investors pay taxes on inflation caused by the Fed. So what? Asset inflation was caused by the Fed. Your assets went up because of the Fed. In many, many cases, you're arguing both sides of the fence there when you say that, well, capital gains should only be on real earnings. Farmers' words. Bullshit. Why? Because everything's relative. Always remember relativism. It's the same for everybody. So it doesn't much matter. Double taxation, you're taxing me twice, double taxation. Oh, for those who primarily make their money in capital gains, it's just not true. If you're making over $1 million a year in capital gains, that's your income. If you're a hedge fund or private equity person and you're claiming your pay as carried interest, which gets a capital gains tax rate, it's your income. If you're Warren Buffett and you make 99% of your money in capital gains, that's your income. So taxing capital gains like income over a certain threshold makes a lot of sense. You're taxing my savings, man. I'm not going to want to save anymore. You're forcing me to spend all my money today instead of save because you're going to tax it anyway. Seriously, do you really think people making $1 million more per year think like that? Do you? Well, I hope you make $1 million a year someday so you can realize you don't think like that. If you're making over $1 million a year and you're pissing and moaning about a few percent in either direction on your taxes, you're just greedy. Because there's plenty of write-offs out there for spending your money certain ways, like paying wages or building something from the ground up. If you're irritated because you're skimming the market is going to go down a few percent and you're making $1 million a year, yeah, that's more than farmers' words. That's kiss my ass. There was a legitimate reason to have lower capital gains at one point, and that was that for decades, capital was scarce. There wasn't an abundance of money. But what have we seen in the last 40 years? That's just not true anymore. Starting in 1982, we started to do massive deficit spending. And then we got to the age of Greenspan and started to do QE. And then Bernanke, more QE. Then Yellen, more QE, and Yellen's back. And then the pandemic, massive QE. Look at this chart. That chart was relatively flat since the 1920s. It started to glide up a little bit in the 1980s and 1990s. Then with the financial crisis and then the pandemic, went through the roof. This is money that will never, ever, ever get paid back with real dollars. Now, it could get paid back with dollars that have been impacted by inflation, but the reality is that inflation is not the boogeyman. We're just not going to pay it back. That's what this comes to. Just not going to pay it back. At some point, there's enough corporate bonds out there tied to this chart that the corporations are going to have to issue shares to pay back their debts, or they'll go bankrupt. Neither one of those things are really good for the stock market about 4 or 5 years out, because that's when most of those debts that got issued in the last year come due. So is it really hard to understand something about why the top fraction of a percent should pay more in taxes? Since 1982, 81, 82, everything that the United States has borrowed as a whole has flowed to the net worth of the top 1% of people. Not just the US debt, but probably the majority of that Federal Reserve money, which accounts for a big hunk of this gap between the 39 trillion of net worth for the top 1% and the 28 trillion of debt almost exclusively accumulated since 1981-82. So under Ronald Reagan, we had a massive change in approach. Spend a lot of money, cut taxes whenever you can. And that recipe has been pretty good for America, but it's been overwhelmingly good for you if you were in the super investor class. Not us. How many of us make $1 million a year? Right? Not too many. So in effect, what we've been doing for 40 years is this. We've been borrowing 3, 4, 5%, depending on the year, from the future for 4 decades. Just selling off little pieces of the country, mortgaging the rest of it. And the interesting thing about that is, like the Federal Reserve balance sheet, we're just not going to pay it off with real dollars. We'll issue longer term debt. We'll print $1 trillion here and $1 trillion there. Why? Why is all this happening? We'll get to that in a minute. But if you have any lingering doubts about the reasons why we need to raise the capital gains tax on a fraction of 1% of the people, here's some reasons from one of the 10 richest guys in the world. He's been the richest at points. What Buffett paid was 17.4% of his taxable income in taxes. I pay more than that. You pay more than that. Why? Why is it that way? Money and power has capitalized on the system to get more money and power. And the most recent elections show that more and more people are becoming fed up with it. And if President Trump hadn't fashioned himself a populist and captured that fringe element, most of those people would have found another way to be populist. The populist movement in the United States is ridiculously strong. It's way over 60% of the population is fed up with the way things are. I think probably closer to 80-ish%. Why 80-ish%? Because 80% of the people can't look out to retirement with much hope. Raising the capital gains tax will help reduce wealth inequality because it will finance some things that we've talked about. In the meantime, stock market is still delusional and leveraged. What do we see developing right now? This is a chart that I showed several months ago. And I said if the alligator jaws get big enough, we'll get a snapback. The alligator jaws are getting bigger. Could it get as big as it was just before the pandemic? It could, because this period here was a massive QE period. That was the $1 trillion to bail out the repo market. This is all the pandemic money pumping up the stock market. And total Fed assets as a percentage of the S&P 500 is opening up the new alligator jaws. Either stock market has to come down, or Fed has to print more money. One or the other. Somebody asked what happened to the repo market. Yeah, go dig up some headlines from September of 2019. It almost caused another Great Recession financial crisis. We spent $1 trillion to avoid that. So why are we deficit spending? Why are we printing money? Well, it's because it's a reaction to the reality of demographics. A couple of charts here from the recent past that I've shown. Most important one is we're now spending more than the economy is growing. That's a problem. And this is all in response to demographics. We know that as families get older, they spend less money. And this is probably a little outdated, because I think a lot of people are still in their peak spending years in their 40s. I'll tell you, as somebody who just turned 51, not me, I'm spending less for sure. And the nature of my spending is changing. I'm looking to invest in real estate and travel. But I'm not buying toys anymore. A couple shirts, a couple toys for the grandkid. That's it. So we know that there's a spending curve in life. As you get older, you spend less. So there's a spike at the end on healthcare. Last year of life, there's a spike. We also know that the population is getting older. This is a couple years old. But this blue shows that the big growth of the economy demographically has ended. Now it's choppy. Hole from the millennials and then rising back again. Then the boomers start to die. And what happens out here will depend on how many people are let into the country at young ages. So all those young people coming across the border now, economically, they're probably positive in the long term. They always have been in the past. But it's, somewhat unknown, so that's scary and people go nuts about it. We don't know how many kids the millennials will have. My daughter's pregnant with number 2. Is that a new trend that people in their 20s are feeling pretty good about things and they'll have more babies? On aggregate, it does not seem that way. And my daughter seems like she's saying that 2 is enough. So it looks like this is just going to chop, which means the big demographically driven growth, the baby boom, is probably over. You're going to have to be a lot more selective on your investments again. Middle class is an offset. So by 2030, a lot more people will be in the middle class. I think that might be a little bit dented from the pandemic. But we know that the middle class is growing pretty quick around the world. Again, stalled out for a year or 2 because of the pandemic. So the big move into the middle class is almost over. Over the next decade, I've told you there's a handful of countries that will benefit from what's left of this shift. Vietnam, probably India, hopefully India, several other countries that are younger in nature, but also educated and have some resources. What's going to move to the middle class after 2030 is pretty small. Population growth is leveling off. But again, the big booms, demographically driven booms, are basically over, or about to be over, or ending. So what can you do to create growth? You can rebuild the world. How many times have you heard me say that? For years, 3 years now. I was very hopeful when President Trump floated the idea of the biggest infrastructure deal ever. Anybody who supported that should support what Joe Biden is doing. It was about the same thing. Pretty close anyway. Close enough. I mean, you can complain about things at the edges. And honestly, I think a $2 trillion infrastructure package is short of the mark. I think it should be closer to 10 trillion over about 15, 20 years. I think there should be that big of a runway. It eliminates uncertainty. It encourages investment by investors. All these shorter term things leave investors to speculate and take less risk, make less commitment. So while this is very good, I would just say, look, you're a one-term president, go balls to the wall. Go back to the 4 trillion that he initially floated at least. Well, these are the things that are going to get investment. These are the places where we should look for investments. And it's not really going to cause inflation, because the big boogeyman, as I've showed, is deflation due to the spending wave. Okay? There's just not a lot of room for inflation. Inflation is not the boogeyman. Deflation is. So in the lumber market, you've seen this scream up. People are like, oh my God, it's hyperinflation, man. Buy Bitcoin and gold. No, it's not. This is speculation in the futures market that's driving the price of lumber up because there's a short-term demand bump. Trees don't grow on trees, man. So it'll just take a little time for this to even out. This is just a minor supply demand issue driven by an event. Events smooth out over time, and we'll grow more trees. And we'll figure out ways to use recyclables, particularly plastics, make new materials. It's already happening. Did you know that you can take recycled plastic bags and create a material that's basically as strong as steel and it doesn't rust? Pretty interesting. It's all out there. So this can't persist. Why? Because in markets, this is a law of economics, in markets with high margins, substitutes and competitors emerge. If you make the price of lumber too high, that means somebody will come up with a technology that used to be too expensive, and now it's not anymore. Because A, they'll improve it, and B, the bar is higher. I'm meeting with the condo association president tomorrow. We're talking about building a building here on the grounds. We're going to time it probably to next year when the price of lumber comes down. Funny thing is I have a condo association here that's done a pretty good job over the years, and we're sitting on $1 million on a property that is in the black every month from fees. So they can pay for this $300,000 building cash. Just a garage with some offices and a community. Probably a lot of brick, to be honest with you. So I don't know what brick is done. But this is not inflation. This is speculation in the futures market because it's tightly controlled, like small caps and micro caps, SPACs. Mathematically, you can manipulate certain markets for short periods of time. That's all that's going on here. Because even with the rise in demand and the constant supply, this shouldn't have shot up as high as it did. Probably belongs down in here, and it will get there. Again, as competition and substitutes get into the market, it might take a year or two. So let's talk about these markets. Consumer outlook on the economy has reached highs post-pandemic. Basically, it's normal again. That's good. And I think it's probably realistic. And the wealthiest Americans are getting even more confident about investing, although they haven't been doing it yet. This is for 100,000 plus. Why? You're making 6 figures, you probably have savings. Smart money, dumb money confidence index shows, though, that the richest investors, the institutions and your 1%ers, have been selling into this market strength. And it's been choppy, pretty consistent since about September, when NASDAQ's big companies basically peaked, and they're just getting back to it now. So this was the first big correction after the stimulus, and it's just been hanging around here as the market goes up. So they've been selling into strength for 6 months, while the retail side got happy. Now some of them are taking some profits, but they got happy again recently. Been talking to dozens and dozens of millennial investors lately. This is coming up on baseball season, so they all want to check for new hats. A lot of them have sold off some of their cryptocurrency. A lot of them have stopped putting money into the stock market. They're buying houses, they're paying down mortgages, they're buying cars. But mostly, they're plumping up their retirement plans, just buying, the funds that are in there. That's kind of good. But the speculation is bad. And as I've said, generally, when the smart money says sell and the dumb money says buy, it doesn't work out so well for the dumb money. Historically, we can see that over and over again. See where the charts show it. It's pretty clear as day. But besides liquidity, what has driven the market up? Well, liquidity has created this debt situation in the margin section. So we have seen margin debt skyrocket since April. This will have to come down probably by 20 or 30%. Why do I say 20 or 30%? Because a lot of margin is manageable. But as people get margin calls, certain accounts will get wiped out. 20 to 30% is a fairly normal margin correction. That probably bring the market down 20 to 30%, at least in certain sectors or segments. NASDAQ margin looking about the same. Small trader call buying still very high. Let that slide in just because I thought it was funny. That one too. So what should we take away here? The Fed has created a lot of zombies. This is somebody else's cover for an article. I see a bifurcation coming to the markets. Winners and losers getting parsed out. Choppy period in markets, a lot like 2015-16. Winners and losers will offset each other. Indexes probably won't climb very much for a while. Probably have a correction, probably have a rally, probably have a correction, and another rally. Maybe a slower growth to the indexes. Because as that chart that I showed earlier, as the percentage of QE as a percentage of the stock market comes down, that's less juice into the stock market, less fuel for an overheated machine. Machine's got to cool off at some point. And if you take the car analogy, usually when a car overheats, you can't just run it slower. You generally got to turn it off for a while. That won't happen with the Federal Reserve. They won't just turn it off, but they'll try to reduce the speed. They'll try to have that smooth landing. That probably manifests in choppy markets, choppy indexes, and you better be good at picking out your winners, because there's going to be plenty of losers. This is the S&P 500. This is that 2015-16 period. Through this ellipse coincide with the tops and the trend. The S&P 500 will get somewhere in here again. Hard to know where. Could it come straight down? Could. Could it break through? Could it get all the way to this level? It could. It probably won't. Because again, I don't think they're going to just stop the engine. They're just going to let it cool down a little bit. So somewhere in here, where you start seeing really big opportunities as time and growth and finances all play together to somehow bring us back to the high end of normal. We're never going to probably get back to normal unless we shoot through it on an event. And those events are very difficult to predict. The one that I see coming is the retirement system is going to need some sort of help. And that happens to coincide with a lot of corporate debt coming due in the middle of the decade. So I worry about 2025, 6, 7, 8, right in there. Charts like this are not normal. This one's GameStop. I left my red line in there because when it was up here, I said it would get down here. So that was a pretty good red line. To me, GameStop is worth under $100 a share. I don't know if it's worth 40 or 80. But it's in here somewhere is what it's truly worth, depending on whatever they can ramp their sales up to. And I think they'll be pretty successful. But even being pretty successful, the stock's overvalued. But you see how this is a narrowing range? The market's starting to figure it out. This isn't a normal chart either. Seriously, charts like this aren't normal. This is a fund. Funds don't do this. This is about a 50 to 60 fund, a stock fund, ARK. Innovation, yeah, that's not normal. I mean, could it be in here? It could be. I think it needs to get down to under 100, somewhere between 80 and 100. That's not normal when a whole group of stocks go straight up because it just becomes the favorite thing to do. No semblance of reality when it comes to price to earnings ratios or EBIT, EV to EBIT. EBITDA, none of it makes sense. They're all double or triple what they should be at. That's why this has come down. Why it probably has another leg down to go. And then when that happens, since most of those companies are good companies, you start going, okay, the sell-off driven by big sellers, like with Viacom and Discovery from the hedge fund, becomes pretty interesting. We start cherry picking. And really, if you were a South Park fan, if you're that sort of demented like me, I'm serial. Charts like this aren't normal. That doesn't make sense. Doesn't make sense. Percentage of transactions using Bitcoin actually went down recently. Why did the price of Bitcoin skyrocket? It's because what I told you before. 2% of Bitcoin accounts hold like 90% of the Bitcoin. Might be down to like 88%. They just manipulated the market. That's all they did. They tightened up the supply as they pushed demand with all these stupid narratives that are out there. The dollar is going to collapse. The world economy is going to collapse. Fiat currency is evil. Central banks are bad. Oh, shut up sometimes. A lot of things are imperfect without being bad. Take your spouse. Imperfect, probably not bad. My girl's perfect. So the bifurcation in the economy is coming. Bifurcation of the markets is coming. This becomes more and more important, that we understand that most of the good companies and mediocre companies and average companies and bad companies are in here. We don't want them. We only want the stuff that can outperform. This is pretty much it. So on Monday, I have the SPAC list almost done, and I got about a dozen other companies as well. So on Monday, we're going to do a double stock session. I'll probably break it up into 2 different recordings, maybe 3, because there are all sorts of stocks out there that are starting to look pretty attractive again. And most of them are small caps and mid caps. As of yesterday, about 80% of the large cap stocks were above their 50 and 100-day moving averages. So the large caps are pretty much overbought across the board. People have been selling off the small caps and the mid caps. Again, those markets take the brunt of negativity or positivity pretty hard because they have smaller market caps. And it takes smaller, lower numbers of investors to change the direction. So when a small cap is cheap, it doesn't take a lot of people to start buying it to drive it up. At the same time, when a mid cap starts to lose favor, maybe because it doesn't fit into the S&P 500 index yet, people start selling it off because they're taking profits, they go down pretty fast. Again, the smaller the market cap, the wider the volatility. And that volatility is good for you if you're patient and you wait for prices to come to you. A lot of prices are coming to you right now. Not in the S&P 500, which I think has some serious churn to go through for years. And then as zombies start to fall out and get replaced by these small and mid caps that grow, because remember what Peter Lynch said, small companies have big moves, big companies have small moves. And I'll add a caveat. Big companies, when they have a big move, it's usually down. If something went terribly wrong, or the market realizes that this company isn't the story that it used to be. And again, I'll throw Exxon out there. Exxon's going to fall off a cliff at some point because they have to get rid of their dividend, have any chance at ever paying down that debt. If you've been watching the news, you know that their problems are mounting. So when Exxon, which was pulled off of the Dow Jones Industrial Average last year, gets pulled out of the S&P 500 someday, and I think that's probable. I don't think it'll be one of the 500 biggest companies in 10 years. What happens to its price the day the market realizes that's what's going on? Off a cliff. That zombie gets replaced by one of these small caps or mid caps that grew. So you should be preparing yourself to find opportunities in the small and mid cap space again, just like I said a year ago, a little over a year ago. because there's more zombies today after the pandemic. I'm not talking about people like me who took the J&J shot. We're talking about companies who got cheap financing to get through the pandemic, to keep people employed, because that bill's coming due. Not for 4, 5, 6 years. Bill will come due. And for the companies that have secular trends against them, like the fossil fuel stocks, that day will come sooner probably. Just consider these 3 points over the weekend as you think about how you're going to invest. The capital gains tax rate changing will help fund rebuilding the economy, rebuilding the world. And it's not going to impact you unless you're making 7 or 8 figures a year. The stock market was already correcting as the smart money sold out. So we just have to wait for the dumb money correction. I don't think it's going to be a permanent scar. I'll be honest with you, I've been pretty impressed with the millennials more and more in their investing. A lot of them who bought into these trends late, who aren't fancying themselves as day traders, they'll take a profit. And they're on that barbell. That's what they're investing in. And the millennials, as I've shown before, are the new marginal money in the market. They are who move the market. If you're a boomer, you're still married to large caps, you need to look across the spectrum of what you own and ask yourself, are they really worth the valuations they suddenly got to? And if they have a lot of debt, how secure are those dividends? Because I don't think very secure. 4, 5, 6 years out, they're going to cut their dividends. And people will have the response, well, I'll worry about it in 4, 5, 6 years. It's a bad response. Because the market will figure it out way ahead of that, because supposedly it's forward looking. The market is pretty efficient, except for the pockets of inefficiency. So things that should happen will happen eventually. And things that seem to be wild, it is largely just a sizing issue. Can a handful of investors move something? Like lumber. Everybody wants to talk bad about SPACs because they just went down in price. They went from mania all the way back, round trip. SPACs round tripped. From IPO price to mania to IPO price. There's a lot of good SPACs out there right now. 30, 40, 50 of them probably. If you pick out the right ones, they will end up on the S&P 500. And as I've said, very hard to bet against scientists. I know it's kind of been the thing in the last year to doubt the scientists. Their process almost always gets them to the finish line, if there's a finish line to be gotten to. You know, they do work on a lot of things that realistically there's no finish line. But where there is a finish line, the scientists usually get there. You know, some bumps along the way, but they get there. So do I suspect QuantumScape will succeed? Yes, but I also suspect that several other companies will as well. Will Space Mobile be able to really put cell towers in space? I think probably. Vodafone and AT&T and Rakuten and other companies, big companies back you, typically means that they see a lot of progress and that you're on the cusp. Same thing with QuantumScape. Gigantic investors in that one. They got in early and they'll make the most. But on that pullback, you kind of look at it and you say, should I throw 0.5% or 1% of my money in there? Because, you know, what if it goes up 20-fold from here? And that's why I talk about focus on the things that can be great, that are past the highly speculative stage, and say, how close are they to the finish line? Can I make 10x or 20x on my money? Because if you own 20 of those, then some dividend producers basically pay for those stocks, you can do pretty good. Just a handful of big winners can change your life. So don't live off of your dividends and your option premiums. Think of those as ways to finance moonshots. And again, you don't just roll the dice. You make very educated analysis on some of these things. And if you're smart, you bet on the scientists, not against the scientists. Just like you always bet on America, not against America, and the American dollar. There's certain things that if you bet on over and over and over again, you're going to win. When I jam all my money in on Ace King suited, I'm behind a pair of fives all the time. But by jamming that ace king over and over and over again, I win most of the time because there's folds in there. Same thing happens with stocks. Theoretically, ace king is going to break even against pairs, basically. But if you bet on enough of these moonshots, and they're essentially paid for from the more conservative gains in your portfolio and the income, you're going to make a lot of money. And this stock market is about to give you a whole bunch of those opportunities. And in fact, some of them are out there already. You've seen me talking about certain SPACs to get involved with. I just got a warning letter from the Department of Financial Institutions in Wisconsin talking about how SPACs are speculative. They just threw out a blanket policy. And the way that they'll enforce it wasn't specific to me, it was just in general. The way that they'll enforce it is the way that regulators always enforce everything. If you're right, nobody says anything. And if you're wrong, people will punish you for it. Bureaucrats protecting their bureaucratic ass. As I've gotten older, I've realized more and more that the world is full of excuses. Don't make excuses about not investing in small cap stocks and mid cap stocks. That's where the biggest winners are. Figure out a way to incorporate them into your portfolio. Next week, I'm going to have like 30 of them for you as we go through the VSL, our very short list, which is still around 200 stocks. When there's blood in the streets like there is with SPACs, right? Time to go out there with your checkbook and see what's going on. Because somebody is selling something cheap because they got a boo-boo. All right. Any questions today, broadly, narrowly, here, there, the box with a fox? Do I have a price target on Space Mobile? Yes, between 20 and $50 billion in market cap. So when you think of price targets, I would say think of in terms of market cap, because you can do calculations on that, right? You can go and say, well, this is their addressable market. This is how much I think they can get to. This is the range I think they can get to of this addressable market. So at a normal price to earnings or EV to EBIT, about what that be. And for Space Mobile, it clearly can be an S&P 500 company in several years, 25, 26, 27, out there somewhere, because that's about when they'll become profitable. And the market will anticipate that ahead of time. So 20 to $50 billion on Space Mobile, and my estimates are generally kind of conservative. That's why I sell stocks like Exact Sciences that I bought at $1.50 when it gets to 70, instead of waiting for it to get to 140. Intel, I think that they're going to be successful in competing with Taiwan Semiconductor. There's no reason they shouldn't be. So while they will lose a little bit of the server space, they'll pick that business back up. But I think that you can just take a look at what Taiwan Semiconductor has done. Think that maybe Intel gets 20 to 30% of that market equivalent. Doesn't mean they necessarily take it from Taiwan Semiconductor. I mean, there's growth in that space, right? If you add 20 to 30% of the Taiwan Semiconductor revenues to Intel, but you subtract, 5 to 10% of their server business, you just do the math. And that math tells me that Intel is worth between 50 and $100 a share. So it's at the low end of that range right now. If it falls into the 40s, you should buy that up, especially if you are retired and you want a dividend paying stock that has growth. Buy it in the 40s, sell it in the 90s, that sort of thing. Somebody asked about the browser alerts for fundamental trends. That is, go to your settings, just make sure that you haven't previously blocked it. If you're using Safari, it probably won't work. But if you're using Edge or Chrome, it will. But just, you gotta go clear out your settings, make sure you haven't blocked it previously. As far as ETFs, there's nothing that's really screaming at me to buy right now. So I haven't really been putting out a lot of those articles, because all the large caps are pulled up and all the spec stocks are still pulled up. The ARC stocks are pulled up. So you really have to cherry pick stocks at this point. I think PBW is the one you should be focused on. there's a whole video on PBW. So go watch last week's Friday video. I think that the alternative energy ETFs are where you should be focusing your attention, because you're getting a correction, and that's where the long-term love in the market is going to be. All right, let's call it a weekend. Apparently I'm babysitting in a little while. That's what that buzzing was, my text alert. Hey, come get the baby. And yeah, we will on Monday cover around 20 SPACs, maybe 25, then another dozen companies, some of these small cap stocks that are just starting to look really good. Small and mid cap stocks are looking really good. And that video will be unlisted, meaning that you can only get it through the chat room. So you go to the chat, click on the link. It's on YouTube, but it's unlisted, so the public can't find it. So if you're not a member of Fundamental Trends or Margin of Safety Investing yet, you should take the trial. So on Margin of Safety Investing, you get a 30-day trial, and on Fundamental Trends, you get a 90-day trial for cheap. So I would at least do a trial and join us for the short run, because I really like where we're going here right now. I think the market's going to give us a little bit more opportunity, meaning some rolling corrections. And I think that the small and mid-cap stocks that have come to market through SPACs or otherwise offer a lot of opportunity, because the retail public, I mean, let's face it, retail investors look at something that's done well and say, I'm going to buy it. It doesn't matter that it went from $1 billion to 100 billion. I'm going to buy it at 100 billion. So all kinds of stocks out there under 10 billion in market cap, but past that speculative, hundreds of millions phase, will it or won't it, stay in business? That's where you have to go hunting. And you especially have to go hunting there now, because the large caps are pretty much all overvalued, and the small and mid caps have gotten pummeled in the last couple months. This is a pretty rare opportunity to get ahead of the changing of the guard. That changing of the guard is happening faster and faster. So whatever corrections we have the remainder of this year, we need to use them. And you want to buy 2 and 3 and 5 and $10 billion companies that have big growth rates, where the scientists have either gotten them there or are about to get them there, or there's some consumer trend that's at their back. In a handful of cases, supply chains moving is going to positively help them, like MP Materials. All right, have a fantastic weekend.